Will 2024 see the start of a long-awaited growth cycle, or are we in for more unexpected economic pain? I'm Joe Galvin, Chief Research Officer at Vistage, here to share the results of our Q4 Vistage CEO Confidence Index. Our latest quarterly survey captured sentiment from nearly 1,400 CEOs in early December, making this a current and reliable predictor for the future. Over the next 10 minutes, we're going to explore the top trends that will help inform your decision-making in the near and long term. The Q4 Confidence Index rose 6 points from Q3 to 82.0. This is a third consecutive quarter of increase, with the index reaching its highest level since bottoming out in Q2 22. As you can see, the 6-quarter trend shows this rising trend. With the Fed holding on raising interest rates and suggesting rate cuts in 24, inflation in decline, and a still highly competitive job market, it sets the table for what we might expect for 2024. And that's why we turn to ITR Economics and their VP of Economics, Jackie Greene. Welcome back, Jackie. I trust you've been polishing your crystal ball for us.
I have been. Thanks for having me.
Well, great. Jackie, can you start by sharing the ITR forecast for 2024 and how the rise in the index aligns with that as a leading indicator?
ITR's forecast for 2024 is of general macroeconomic recession. So if we're looking at US GDP, we're going to see 2 quarters of decline in 2024. They're not going to be necessarily consecutive, but they will be occurring in 2024. For industrial production, we've actually seen the decline beginning already. It started back in September, and that's going to continue on through 2024 as well. So how that aligns with the Vistage Confidence Index, though, is the rate of change for that confidence index is actually on the rise, which currently ties in with the trend we're seeing in GDP. So while that's good at the moment, the reality is we're expecting that to tip over in decline for GDP. And when I peeled back the layers of what's going on in the index, it's really because the value of the index 1 year ago, and actually for the upcoming quarter 1 year ago, was so low, it's creating this boost in the rate of change. But if we're actually looking at the raw value of the index overall, it's still relatively low. We're still coming off what were essentially pandemic levels, but post-pandemic. So that's where we're getting that rise in the indicator that's not necessarily translating into rise in the economy, given our outlook for 2024. And this is not just the Vistage Confidence Index. I've seen this in a lot of leading indicators lately, and that's why we're having to do a lot more deep dive analysis on these things.
You know, Jackie, our data supports that because it shows that while there is a rise, it's rising to the lowest levels we've seen going back. And I like to compare to the 10 years of the 2010. We're historically low on the economic expectations, while the other areas are starting to recover a little bit. Let's get into the first trend, and that is economic sentiment for the next 12 months. It continues to improve. Is that because it can't get any worse? Or can you help us understand what's happening in the economy and the action CEO should take because of that?
When I saw that, there were 2 things that came to mind. One, this is Vistage. Vistage is full of very smart, motivated, intelligent people who are really driven to control their own fate. So yes, they're feeling optimistic because they feel that this is something that they can conquer. This is something they can work with. They're not going to let the economy beat them down. So that's part 1. Part 2 is, as I just mentioned, the GDP numbers look up. So some of it is probably some sentiment from people who also are seeing the GDP numbers are good and feeling like, all right, this really could be a soft landing in 2024. I have to beat that part down because we are still expecting that recession in 2024. And the thing that I really want people to walk away with, if nothing else from today, about what to do with it. Expect interest rates to stay relatively steady in 2024. There might be a little downward movement, but we are not going back to where we were pre-pandemic with those interest rates. They will not hit that floor again. So you really need to be factoring in, how can you best manage your finances and your customers' expectations in this new reality? It's going to be tight. What can you do about it?
Well, there's no questions that CEOs are grouchy about interest rates. Cost of money is up and cost of capital is up, and we're seeing that impact across the investment spectrum. But let's turn to revenue and profit expectations because they continue to improve. Although, again, to your point, they're historically low. Last quarter, we talked about profitless prosperity. And while the percentage of CEOs who expect increased revenues has grown to 59%, there's still a gap in profits. Jackie, we discussed the cost of inputs, specifically wages, as something that's contributing to this gap. What are you seeing as the other indicators that you monitor to this gap between revenue and profits?
We're watching that profit piece where corporate profits are down. But I want to keep in mind that they're down off where they were, but they're still historically at a relatively healthy level. So keep that part in mind as we're going through things. What we're watching are the pieces such as the consumer price index, the producer price index. Why that's so important is because that profitless prosperity you just mentioned. If corporate profits are going down, we're glad to see some easing in the pricing pieces that will help protect some of that profit margin, but it's not all going to go down. You'll see some commodity prices go down, but wages are not likely to be going down to that level. So what can you do to protect your profit margin is going to be the key here. Don't get caught competing on price alone. Really hone your competitive advantages. What do you do better than your competitors so that you can promote that aspect of things and really drive that home so you're not competing on price alone and protecting that profit margin.
Right. Moving on to investments and hiring, we see that CEOs are more conservative in spending. Fixed investments is the only category that didn't rise in the index, with just 22% report they're seeking capital in 2024. However, hiring's become more aggressive. 56% of CEOs are planning to expand their workforce in the year ahead, an 8-point increase from last quarter, but more importantly, equal to the 10-year trend of the 2010s. Human capital is needed not just to meet future demand, but to fulfill current demand as well, as 48% of CEOs report they're not operating at full capacity due to challenges in hiring. Jackie, what are you seeing again on the wages and job front that might affect the ability of small and mid-sized businesses to effectively hire?
Expect a relatively tight labor market to persist. However, what I would warn first is factor in where you're going to be through 2024. We're expecting this recession in 2024. You know business will be down. Think about what employment needs you really have with that in mind. Then also factor in we expect rise in 2025. Not aggressive rise, but there will be rise in 2025, okay? So think about where your business will be. Think about how long it takes you to hire people, how long it takes you to train them. When do you need to bring them on board? If business for you is going to be picking back up to the 2023 level come early 2025, and it takes you a year to train someone, by all means, get them on now. If you are going to see business fall through 2024 and not really get back to the 2023 level until late 2025, and it only takes 2 months to train someone, hold off on that role. You don't need to bring them in right away. You can wait until you're in a better cash position and you can manage that expense that way.
So hire into the growth cycle, knowing that when the growth cycle hits, everybody's going to want to hire.
Yes,
Right.
But you'll know it's coming first, so you'll be ahead of it at least.
There you go. So Jackie, finally, you put all this together, and what does it suggest? Maybe not so much for 2024, but more importantly, beyond. How long will this growth cycle last, and where does it lead us to?
Big picture, 25 has growth. It's not a massive aggressive growth, but there will be growth. Things get stronger again in 2026, so we have a couple of years of growth ahead of us. Realistically, after 2024, it's a general growth trend until we hit the depression era that we've been talking about. There will be some bumps along the way. It's not going to be all perfect rise, but you can expect some general growth after this recession in 2024. Expect general growth for the rest of the decade.
So the rest of the decade does not change the fact that 2030 is on the horizon and ITR's prediction of the Great Depression is still out there.
Very true. I'm not going to lock down to 2030 just because it's so far out. We could waffle a little bit, come in 2029, go to 2031. But for the sake of the conversation, we all call it the 2030s.
Great. Thank you, Jackie, once again for your insight, your expertise. Everyone looks forward to what ITR says, and you're such an important part of our community. So thank you so much. Your guidance and analysis will help leaders of small and mid-sized businesses understand how to approach the new year and where they should be more conservative and where they should place their bets. I'm Joe Galvin, Chief Research Officer for Vistage, and I thank you for your time.